All right. Welcome to the January 23rd edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a bit about South American weather and the changes we made to our forecast for Brazilian production and what people are saying about the Argentine crop, which is a little different than I think, at least it varied a bit from USDA's estimates, although not it was at least directionally the same, or is at least directionally the same. And then we're going to talk a little bit about China and what's going on there. Over the last week or so, there's been a real collapse in Chinese equities prices. And while that typically doesn't have a super strong and direct correlation with vegetable oil prices, the amount of concern about the decline in the stock market makes me think that maybe there's something a little bit bigger going on there. So anyway, that's what we're going to cover. We'll start with what's going on in South America. So harvest continues, and we met this week. We met both with the editorial side of Fast Markets and talked to them about what they thought about the crop. And then we also met with some other with Joao's former employer and talked to him about what they think about the crop. They do a lot of big crop tours, and so they really have a lot of on-the-ground information about how things are looking. And generally, we reduced our estimate, or Joao reduced his estimate to just under 155 million tons for Brazil, which was generally in line with other estimates we heard. However, there are some farm groups and some other market participants that probably have a vested interest in whether the crop is 150 or 130, and they tend to lean towards the 130. Most farmers I've ever interacted with believe that crops are smaller than reported and prices should be higher than reported. Of course, if I were a farmer, I would feel exactly the same way. But this year, I think that there is another thing that sort of making people's expectations for the Brazilian crop decline a little bit more than they probably should, and a little bit more than I expected. One, I think the last 3 years have set expectations for what happens to South American crops if the weather isn't nearly ideal. And so I think part of that and part of what happens when the weather or the ENSO measurements shift from La Nina to El Nino, particularly as quickly as they did this last go around. Usually it takes a little while. They can the sea surface temperatures can kind of remain close to neutral for a year or more, and then it switches. And this was straight from La Nina to El Nino, basically. And typically, or historically, El Nino has had an impact on yields in the north. Also historically, or I guess the way that I should say it is, Brazilian soybean production has expanded from the south into the north. And so also historically, the impact of El Nino on northern crops didn't have such an enormous impact on the Brazilian production for the year. Now, that's changed because most of the expansion over the last however many years has been in the north and northeast. And so that part of the crop makes up a more significant portion of the overall total. So I think it is fair to say that El Nino probably has a bigger and different impact on production even than the last time the sea surface temperatures were warmer than normal, which would have been probably 2018, 19, maybe 19, 20. I think by 20 we were either getting close to or in La Nina. And so because of that, the impact of particularly the drier and hotter weather at the beginning of the year will probably have a larger impact on production than it would have even, like I said, 5 years ago. However, crops in the north still don't, the main producing region is still Mato Grosso to Sol, and then a little bit more south from there. So the majority of the crop is still grown in central or center west and in southern Brazil. And generally those conditions have been fairly good. The crop that the other part of what's gone on that I think is ratcheting down expectations for Brazilian production is that because the first half of the year was dry and then conditions really improved, what we've heard is that the crops that were planted early suffered, and then the crops that were planted later benefited from the weather conditions, or at least weren't hurt by the growing conditions early in the season. And so it seems like, or it seems to me, and this is completely anecdotal, and it doesn't really, we haven't looked at the numbers to confirm this, but it seems to me that farmers have harvested, or some farmers have harvested their worst crops. And so a lot of their expectations and a lot of what the market is seeing in terms of anecdotal yield reports are based on those yields, which were not very good. And the difference in yields from sort of the early planted soybeans to the late planted soybeans is really, really significant. I mean, it's sort of the difference between something like maybe as low as like 5 bushels an acre to like 60 bushels an acre for the later crops, or potentially, I guess I should say 60 bushels an acre for the later crops. And so because of that, it does tend to feel like current expectations might be the worst that we see through the year. And then the crop will get bigger. People's expectations of the crop will get bigger as farmers start to move into harvest for the better crop. I think there's some portion of the later crop that still is in pod filling, and so the weather is still important, and the forecast hasn't really changed. It still calls for periodic rainfall that would help improve yields for those crops that are still in pod filling. For anything that's not in pod filling, obviously the yields are what they are. But if the second part of the crop, which is really the bigger part, so it's really sort of 1/3 early planted, 2/3 later planted this year. And so as they get into that 2/3 of the crop, I think, and if the weather continues to cooperate, I think what will happen is anecdotal yield reports will improve, and then market expectations will kind of start to swing back, or at least swing away from the 140 or those kinds of estimates, which I think are just too low. I will be really, really, really surprised if the Brazilian crop starts with 1.4 and whatever after that. Our estimate 154.7 puts Mato Grosso below last year's yields, which were really, really good, and closer to the yields of 2 years ago, which I think makes sense. And then in other northern areas, there have been some northern areas that have had better weather relative to last year. And so there's some of those that improved a little bit, but these are very small producing areas. And then in the south, there is improvement over last year because of the drought last year. So very small bar to hurdle over. And the South tends to look, other than RGDS, where the rainstorm just came and didn't stop for a while, most of southern Brazil looks a lot more like Argentina, which is is doing extraordinarily well. And I think people's expectations, USDA raised their forecast from 48 to 50 million tons. And there are people that are already talking about sort of 60 million tons out of Argentina. The Argentina production is critical to offset any of the declines in Brazil, but the losses were so great last year that a 50 million ton crop will essentially offset any losses in Brazil probably. And a 60 million ton crop would just do more of that. And so it's very, very hard to see out of just Argentina and Brazil. You've also have Paraguay in there that is not going to contribute hugely to world soybean supplies, but it's an important country and producer in South America, especially for the South American crushing industry. They're also coming back. They looked a little bit more like Brazil or Argentina last year than they did Brazil. So there's another couple million tons. But if we just focus on Argentina and Brazil, it's very hard to imagine how we get a crop that is lower than 200 million tons compared to last year's sort of 170, depending on where you put Argentina and where you settled on Brazil. But if we call Argentina 25 and Brazil 155, that gives us 180. So 20 million ton increase, which is 720 million bushels or so. That's a significant increase. And unless the weather pattern changes and the Brazilian crop really is below 140 million tons, it seems likely that that prices will continue to remain under pressure. Now, there will also be, looking forward through the first half of 2024, there will also be a period where the market adds back in some weather risk premium ahead of U.S. planting, ahead of and during most of U.S. planting. So prices may stabilize around current levels and then start to move up. Soybean prices, soybean futures. But as that crop hits the market, it seems likely at the very least cash premiums in Paranagua and in the upriver ports in Argentina probably are going to come under a bit of pressure, and futures prices probably will, if they stabilize here, will probably start to move back down in sort of June or early July, depending on what U.S. weather looks like. And that's going to make it difficult for soybean oil prices to rally. However, like we've talked about before, there has been a fair amount of short oil share trading, and U.S. domestic soybean meal demand has been really robust, and so that's helped support meal prices, and the spreading kind of has kept oil prices down a little bit. I still think all of that sort of gets resolved, and we're back to kind of neutral on positioning, or maybe even long oil share positioning here certainly by the second half of the year. Probably the second quarter of 2024 is going to be the changeover. And then oil prices will be supported, but probably supported in an environment where soybean prices are falling, and so stable or slightly higher into the end of the year is kind of our forecast, after a fairly significant decline here in the first quarter or half of 2024. Right now, our forecast is down a little bit more strongly than I think is probably possible. But the move in soybeans has been substantial and is sort of driving part of that larger than expected decline in the near term. So take the near-term forecast with a bit of a grain of salt. The increase coming out of there, the slope of that line is probably right. It's just a matter of where we stabilize and start to turn higher. All right. with that, let me switch over. I have a very short presentation today. I'm trying to cut this down so that it's not so long. All right. Okay. So in China, much like most places, the protein or oilseed demand is really driven by protein meal demand. And so this just shows China's protein meal demand by oilseed over the past 10 years or so. And you can see that that protein meal demand has kind of stabilized around 90,000 tons. Got up above that level, and then 21, 22, and 22, 23, you saw an uncharacteristic decline in protein meal use. Part of that is due to the impact of ASF, and part of it is probably due a little bit to, or well, probably almost all of it is due to ASF. And then the Chinese government decided to use ASF as to help restructure the hog industry in China, to take it from what was a relatively small kind of rural industry and turn it into one that was more industrial, I guess is the best way to put it, with the big hog hotels. And everybody thought, and I thought this for sure, that as Chinese hog farmers made that transition, the intensity of meal use would increase, because if you have 3 pigs in the backyard, you tend to feed them table scraps. And if you have, 300 sows in a breeding facility, you tend to buy them manufactured feed, which uses a lot more soybean meal than the table scraps. So it seemed like ASF was going to provide this opportunity to revolutionize the industry, and I think to a large extent that has happened, or at the very least has started and moved a significant way. ASF came back a little bit. African swine fever came back a little bit after they thought they had it eradicated. And that has kept the growth of meal demand a little bit lower than a lot of people, including myself, thought it would be by this point. If you look back sort of 2013 to 2013, 14 to 16, 17, or 17, 18, that was a growth rate in Chinese meal demand, when a big chunk of their farmers were farming hogs in their backyard. And so I think it was easy to extrapolate that that meal demand was going to grow at that pace, or even faster, after they revolutionized the industry. And I think that it was really easy to get excited about how much meal and therefore how many the volume of oilseed that they would need to import to produce that meal. And then ASF came, and it kind of really threw a monkey wrench into everything. So we've gone sideways, essentially, or Chinese meal demand has gone sideways since, or at least usage has gone sideways since 2017, 2018. I do think that the growth in meal demand will get back on track. However, I don't necessarily think that we're going to see the same increase, the same pace of increase that we saw in sort of the 13, 14 to 17, 18 period, because I think at this point, it's clear that the transition of the Chinese hog industry from 5 pigs in the backyard to the hog hotels probably doesn't have as significant an impact on the intensity of meal usage as I thought it would. So I do think that going forward, we probably get back into a year-over-year growth in hog numbers, meal demand, all of that. However, the reason that I don't think we grow as quickly as we did from 13, 14 to 17, 18 is that during that time, probably more so than now, although I think it's still an ongoing process, but China was pulling a huge population up from a more agrarian lifestyle to a more manufacturing economy, manufacturing-based economy lifestyle. So that transition tends to, if you've heard of the protein ladder, if you are in a developing country, the amount of protein that you get is relatively small, but as your country becomes richer and as per capita GDP goes up, people tend to switch from eating rice to less expensive forms of protein like chicken. And then they move up to pork is a little bit more expensive, and then beef is obviously sort of the top of the protein ladder. And so 13, 14 to 17, 18, China was still in that process. And Chinese soybean imports soared because of the growth in meal demand. I think we probably will get back to that year-over-year growth, but it won't necessarily be the year-over-year increases that we saw back then. And that means that the year-over-year demand for oilseed and meal will not grow as quickly as it has in the past. And that means that there is sort of more oilseed. If oilseed production continues to grow at the same rate and Chinese demand starts to grow again, I think that oilseed production probably will outpace the growth in Chinese demand now. In 13, 14 to 17, 18, that wasn't necessarily the case, although there's some drought, some impacts of drought in there that skew it a little bit. But back then it was always, what are China's soybean imports and is that number high enough, essentially? And that was, they were importing kind of 95 million tons of soybeans. And now they're importing just a little bit more than that. We're all these years later. And so the growth in Chinese demand for oilseed, specifically soybeans, will come back, but it won't be as strong, nor will it grow as quickly as it used to. And so if the growth in production continues at the recent pace, not necessarily the South American pace this past year, which was impacted by drought the prior year, but I mean sort of the year-over-year increase in trend line yields, if you forecast trend line yields out of it. If that happens, then I think that you probably at some point will get to a spot where we start to decrease soybean acres and soybean prices stabilize wherever they stabilize. I think one of the things that was interesting about the meetings that Joao and I had was that when we talked about soybeans trading under $10, people did not guess or did not remember how recently soybeans had traded under $10. And the last 3 years have really skewed expectations for where prices can go and where sort of fair market value is. But prices traded at $8, almost $8.50 for soybeans in 2020 before they took off in April. So not really that long ago. And if the growth in Chinese import demand is slower than it had been historically, but the growth in world production remains close to where it has been, then the world will start to build stocks and prices will remain under pressure, potentially trading below 10. That said, there's always the potential for a weather problem in the US or in South America. The weather conditions this year obviously are settled. Next year, again, El Nino doesn't tend to cause significant issues in South America. In the US, it can have an impact, I guess, although I don't remember a specific year. Maybe 2012 was an El Nino year, but I don't think that there's the kind of correlation with El Nino in US weather conditions during the summer, the same level of correlation as there is in South America or US conditions in the winter. This year has been by far the coldest year since I've moved down here, and I think it's probably been the coldest year so far for much of the nation in the past 4 or 5 years. So if all of that happens, there should be additional oilseed supplies that can either be crushed in the markets where they're grown or can be exported to countries like China that then have a domestic crushing industry and crush them themselves. Now, traditionally, China has preferred to crush oilseed rather than import vegetable oil. However, in several years, China has imported a substantial amount of vegetable oil, and it's usually because, or it can be because the supply of one of the other oils that they use is limited. So the example I always give of this is sort of the drought in Ukraine a couple of years ago limited sunflower oil supplies in 2020. China went and bought a bunch of soybean oil from Brazil, and that really started to kick off the rally out of the pandemic lows. This year, it seems like, or it seemed like, there were some the supply of I guess the supply of sunflower oil again probably was a little limited coming out of Russia, and so China bought a bunch of canola oil from Canada. In the fact that they're buying oil instead of buying the seed and crushing it says two things. It says, one, Canada doesn't really want to export canola seed to China. We've talked about that a lot in terms of as we adjust our Canadian crop number, we tend to favor changes to exports over changes to crush, particularly when the crop is smaller than expected. And so as a result, the Canadian agriculture industry would just like to export the products and capture the crushing margin for themselves. Most of the time, China is a large enough buyer that they can sort of dictate that a little bit. But given that Canada's neighbor has embarked on a new biofuel policy that increases the demand for vegetable oil substantially, and Canadian crushers would still like to crush canola and sell the vegetable oil to the US, to US renewable diesel producers, China kind of, in some respects, took what they could get. Now, I kind of spewed all of that to Joao, and he went and actually looked at the Chinese data and said, I don't think that's what happened this time. And that's probably true. But it is a potential, and China is a big enough importer of agricultural goods that small differences like that can have a significant impact on the markets that they occur in. So China may not have China's sunflower oil supplies this year may have been sufficient to sort of carry them through with the domestic demand that they usually have. But so they may have bought in the canola oil because they couldn't buy the oil seed that they would typically buy from Canada to crush. China has for a very long time wanted to increase the amount of oil seed that they produce domestically, and it seems like every time they have a new 5-year plan, that 5-year plan sort of includes doubling the production of oil seeds, specifically soybeans, since they import roughly 100 million tons of soybeans every year. Any production increase that they can get is critical. I think I think part of the reason why China ended up as a relatively large corn producer and not necessarily a large soybean producer is because they started to grow corn earlier, and then corn took over a lot of the area, and then they and the rest of the world, I think, figured out that you could use soybeans for a lot of things. They were useful, and so China started to try and grow soybeans, but they don't have sort of the same split that we have here in the U.S., which is not quite 50-50, but relatively close. China produces a lot of corn in relatively small amount of soybeans, and then they import the rest of the soybeans they need. Historically, China was self-sufficient in corn, and so I think for a long time it also made sense for Chinese policymakers to continue to support corn acreage and not necessarily increase soybean acreage, because early on soybean imports were small, and they really used all the corn, and they actually planned at some point to be major exporters of corn. They built a big port so that they could ship corn to Korea. And now that port actually imports corn, and it looks like China's probably going to be in the market for about 25 million tons of corn this year. So they're not at this point sort of the let's continue to support corn because we're self-sufficient in it and we don't have to import anything. That argument doesn't work as well now that they are having to import 20 million tons or 25 million tons of corn. However, I don't think that it necessarily means that Chinese farmers are all of a sudden going to switch wholesale to soybeans. And you can see that the harvested area for all oilseed production in China has been flat to a little bit lower over the past 15 years or so. And that as a result, production has been relatively steady during that time. It has grown a bit, but not really in the same way that demand has grown, for sure, or in the same at the same pace that imports have grown. So it does seem like they are not necessarily giving up, but not as aggressive about actually expanding production as they would like to be. I think the first 5-year plan that I saw that wanted to double oilseed area was in the early 2000s, and I think they were producing about 10 million tons of soybeans at that point. And so now they're producing 20 million tons, but it's not 5 years later, it's 20 years later. And so again, while Chinese demand is strong, I think that there are going to be a couple of shifts that go on here from where we were historically. One, I think the year-over-year growth in protein meal demand is going to slow relative to where it was when they were growing before. And two, I think that because of the shift in U.S. biofuel policy, it'll be more likely that exporting countries will export vegetable oil or protein meal to China rather than oil seeds, to the extent that that makes sense. Now, I don't mean that China is going to import every ounce of rapeseed that they use but don't produce domestically. I think Chinese buyers will probably import vegetable oil when oil seeds aren't available. If oil seeds are available and it makes sense, then I think that they will just import vegetable oil. Um, okay, so that was supposed to lead into this, which there is a chart that has, I apologize, bear with me one quick second here. Sorry about this. I want this to, okay. Sorry, this is what that chart, I'm not sharing that. Bear. Okay. Can't get this to work. There's supposed to be an import line here that bounces below 5,000 until you get out here, and it creeps up, and then last year it goes down. We've got it coming back up a bit. The point of this chart really is to show that to reinforce a point that Chinese buyers don't necessarily like to buy vegetable oil. So for all of the increase in uh, Chinese vegetable oil usage, which is uh, substantial, even if it is growing relatively slowly year over year. But all of that growth hasn't necessarily resulted in a similar increase in vegetable oil imports, which is a little surprising. However, again, China prefers to import oilseed and crush the oilseed, produce it domestically, and then consume it. And so that's why you don't necessarily see the same slope of the line for imports that you do for domestic demand, even though they still are essentially importing all the vast majority of the vegetable oil that they use in the country. They just import it as a seed and then crush it themselves. We expect Chinese vegetable oil demand growth to kind of continue along the same trend. I don't really see that there's any reason to expect a significant increase in the growth of Chinese vegetable oil. There is not a biomass-based diesel biofuel policy in China, so they don't produce any biodiesel or renewable diesel, at least not now. Their participation in the biofuel markets has really been as a feedstock supplier, and that seems like that's going to continue for a bit. China does produce ethanol, and so they're not wholly opposed to biofuel, but I think that I don't know why they don't do biodiesel. I guess it's a little more expensive and I honestly don't know. I'm curious now. We'll go check that out, and if it's interesting, we can talk about it a little bit. Either way, there's nothing in the Chinese data that would suggest that we'll get a repeat of sort of the 2020 scenario where China was really short vegetable oil and needed to import a lot of vegetable oil from Brazil or Argentina, and that kind of soaks up a lot of the supply because it looks like there's going to be a lot of supply that needs soaking up. So to the extent that China does buy vegetable oil going forward, I don't think that it's necessarily going to have the same impact on price that, say, Chinese purchases of soybeans would if they really started to accelerate their imports. If they went from 100 million tons this year to 125 or something next year, that would have a significant increase, or that would have a significant impact on prices. And almost whatever they do in vegetable oil, it can have a significant impact, certainly, but the market has changed over the last couple of years, and the response of the ag industry broadly, not just in the U.S., to the changes in U.S. biofuel policy have made it seem more and more likely that we probably are going to overproduce relative to the growth in demand, in particular because of the UCO stuff that we talked about. There's this growth in imports that is a little tough to nail down in terms of what the actual capacity to increase those imports are. And so I think prices have hung on a little longer than they needed to get a proper response. And so we're probably going to go into a little bit of oversupply, which again will probably weigh on prices a bit here in the first half of the year. And then going into the second half, it looks like demand is going to be stronger than supply, but we'll kind of see where that shakes out when we get there. All right, last slide, and then somebody was kind enough to ask a question, and so I'll try and answer those. Okay, here is a chart that I got from a blog called Dim Sum. Is a really good blog, and I'm using it without permission now, but I'm gonna, if the guy has a subscription, I'm gonna subscribe to it anyway. So please don't take this and use it because I don't necessarily have permission to use it. But it's tough to find Chinese data, and so this was already put together, and I was running late. Anyway, so this kind of shows what the Chinese hog price has done, and corn and meal. And in December, Chinese hog prices fell 14%, according to the National Bureau of Statistics. And that was the biggest decrease that prices had seen since probably at least 2021, it looks like. Um, the decrease in prices suggests that, contrary to what the crush margin is telling you or Chinese soybean import demand is telling you, that there is not a significant problem with hogs, at least relative to demand. Now, it may be that Chinese demand is down a little bit, or maybe it's down a little bit more than a little bit. If you go back to the protein ladder and you think about that, if you are middle class in China, or maybe just on the edge of middle class in China, over the last 5 years, their property market has really caused some problems, and that's part of what's pressuring the stock market right now. And so your house is probably worth a little less than it used to be, and now stocks are starting to go down, and your parents or grandparents, I guess, depending on how old you are, have some stories about the old times, very similar to if you're my age, your grandparents went through the Great Depression, and they will have told you a lot of times, especially when you're throwing away, I don't know, a quarter of some unedible sandwich, about how times were tough in the Depression, and you shouldn't waste food. And those are all really good and true lessons. The difference between that lesson and the lesson that the Chinese culture learned was that uh, they had millions and millions of people starve. And so they take food security really, really seriously. And it wouldn't surprise me at all if the average Chinese consumer, following a decline in their house price and then a decline in stock prices, might be concerned about the economic future of China, and whether they need to prepare for a little bit of rough time ahead. And in that case, maybe you move down the protein ladder a little bit. Maybe you don't eat as much pork. And so maybe it's a bit of a demand problem, as opposed to a supply problem, or a supply and demand problem. The supply is still growing at the pace that it should be growing, but the demand is falling off a little bit because of the economic uncertainty. I don't know 100% that is true. It's just sort of one explanation, because there were some reports earlier that ASF was coming back and was causing some issues. It may be that those reports were overblown or early, and ASF wasn't that large of a problem, and Chinese hog demand is, where Chinese hog production is still growing and still recovering from ASF. I don't think that the crush margin or soybean imports reflect that necessarily, but I don't know that those are super. I think they're good indicators. I don't know that they're gonna, move for move with the hog inventory. I don't know that that's the case. I generally look at them as broadly reflective of the trend. And so if the trend is stable, or maybe even hog numbers are up a little bit, that wouldn't necessarily surprise me. It would surprise me if hog numbers were huge, and people are talking about how much soybean meal China is going to use, and how soybean imports are going to get back to their old growth rates. Because I just don't know that that is true, and it's one more piece of the puzzle that suggests that the trends and the fundamentals of the market that have driven prices over the last 2 or 3 years are really changing, not only from the perspective of, well, we found the supply, or we think we found the supply that will meet the growth that we have in biomass-based diesel feedstock demand, but also in the things that we look at. Because if we have found enough supply, UCO from China and tallow from Australia, to sort of sort out the growth in feedstock over the next couple of years without having to make massive reductions in our expectations for non-biodiesel domestic usage, then that isn't going to, it's still significant amount of the total demand. It's approaching 50% of soybean oil demand, domestic soybean oil demand now. So it still is really, really important, and we'll still pay very close attention to it. But it's not the only thing that we have to pay attention to anymore. It has been the only thing that we've had to pay attention to for the last couple of years. So we've been able to just kind of trot out the biodiesel production, biomass-based diesel production numbers, the growth in plant capacity. But I think the market is going back to what it was in some respects before that. Again, the demand from biomass-based diesel is there, so that's not going to change. But the impact of that demand or the newness of the demand is not the same, and so the impact that it has on prices, or the impact that changes in it have on prices, probably isn't going to be the same. And so I do think in what we're going to try and do, we're not going to stop talking about biomass-based diesel, obviously, but what we're going to try and do is highlight some of those other things that we're looking at so that you can kind of pay attention to them with us. All right. Let me see if I can stop sharing this. And then I will answer some questions. Where did that go? Wow. Lots of questions this week, and I was actually sharing, so not what happened last time. Do you have charts to show for your current discussion on South American production? We do generally. We typically include a couple of weather charts at the beginning of the presentation, and in all honesty, I thought we have a file that's called China oilseed val, and it's where all of our China data is, and I thought I had more charts built in the China data. So I told Joao I didn't need anything from him this morning, and I probably could have used a couple of charts. Reach out to Joao, and we will set up a call or get you something. But send something to Joao, and we'll get together. Any updates on why California LCFS credits remain so low? Nothing has changed. I don't know. I mean, I think they've stabilized at current levels based on production and on the current policies that CARB has implemented around the LCFS program. I expect that that you will see a rally into the announcement of the new policies, even though I think they're relatively well known. And then what happens after that, I think, will depend a lot on exactly what those policies are. However, I do think that there is some chance that CARB implements new policies that raise LCFS credit prices. That attracts more fuel. That pressures LCFS credit prices. I think there may be a bit of that. Whether the increase in fuel is enough to drive credit prices back down to this level or not, we'll have to see, because we already ship so much of the domestic renewable diesel supply to California. There isn't that much more that we can increase that. And on biodiesel, there's a lot of room for increase. And maybe that's where increases come from. Renewable diesel will increase with the growth in production, obviously. But there is going to be, I think there is going to be a bit of for a little bit in the marketplace, I think there's going to be a bit of how much does raising the price attract more volume and ultimately pressure the price. So I still think there will be a run up in prices into the announcement, the official announcement, and then you may get a little bit of pressure, especially if volumes increase. But right now, and I think sort of what I have said in the way that we approached this was I thought that I thought that they would implement those changes early in 2024, and it looks like it's probably going to be closer to the middle of the year before they get those implemented. So I've had sort of a run up in prices heading into 2024, and still have built into our forecast kind of increasing prices through the year based on this idea that the changes CARB makes will support prices. I still believe that part, but it may be that we're stabilized around here for a little bit longer, at least until there is a lot more certainty on what CARB's going to do and exactly when they're going to do it. And again, maybe there is, maybe that's a little bit more certain than I'm aware of. I haven't looked into CARB in several weeks. So if something new has come out in the last couple of weeks, then I wouldn't have I wouldn't have seen it. What is the outlook for animal fats? This is really a feedstock call, so please always feel free to ask about either. For animal fats, it really is the growth in UCO imports are going to have a significant impact on the price outlook for animal fats going forward. And based on the October import data, it looked like animal fat fundamentals could get really, really, really bearish. The November UCO import data was about half of October and fit more with our assumptions for the fundamentals. So I think that if we do get a return to sort of 400 or 500 million pounds of UCO imports every month, then the outlook for animal fats is going to get really, really bearish. If it's closer to the November number, which was 200 and some odd million pounds, then I think that we are relatively close to the supply, the consumable extra supply of animal fats that are produced domestically, if not already sort of over that. And I guess that's what the growth in imports tells you, is we're sort of already over the consumable excess supply of animal fats. So much like our soybean oil price forecast, we have prices for animal fats coming down a bit early in 2024, but then we have them coming back up in the second half of the year as vegetable oil supplies get tighter relative to demand. That will all depend on really the volume of UCO imports and tallow imports. U.S. production, I think the market probably has a pretty good handle on what U.S. production looks like now and how it can vary. The big unknown in animal fats is how much of it can we import from the rest of the world, and how long will those imports last. For UCO, it's kind of a, continue to grow import volumes until the exporting countries devise their own biomass-based diesel policies and implement those. From that perspective, China being a major supplier without a biomass-based diesel program means that those volumes probably are a little more secure than, say, the tallow volumes out of Australia. Nothing against Australia, but I think they're more likely to implement a biomass diesel plan or a SAF plan. The SAF plan is probably far more likely, but that will take up a lot of the tallow. If they make SAF out of renewable diesel, that will take up a lot of the tallow that they're exporting. And so that in the longer term, that interaction is going to guide animal fat prices. It seems like one scenario that you could argue for in the longer term is that as the exporting countries start to set up these policies around SAF, that there's going to be sort of a game of musical chairs for biomass-based diesel feedstocks. And the US is probably one of the largest consumers, may miss out a bit. And if that does happen, if we get 4 or 5 years down the road and then import volumes start to move lower, then you could get an explosive move in animal fats prices in the short term over the next year. I think we're probably steady to maybe a little bit lower here for the first quarter. Call the second quarter kind of stable at whatever level that is, and then third quarter and fourth quarter, we would expect that they start to rise again. You can, I will, can we have access to your weekly presentation? You can, if you send me an email, I will send you a copy of the presentation. If you've sent me an email recently, I apologize, I haven't been as responsive as I would like to be. I'm going to try and get caught up on email this week. So if you send me an email, I can send you the presentation. This one is short. Usually they're a little longer. Do you have any comparisons between your weekly assumptions for future volume and pricing projections versus actual market results? So are you, you're asking whether we track our accuracy on our forecasts, and we do. Currently, we don't actively track it. We did a project and we tracked it a couple of years ago. The reason we don't actively track it right now has to do with how we have to save the weekly forecasts. Saving a soybean oil price forecast and comparing that is relatively easy. Trying to save all of our fundamental projections and trying to measure the accuracy of those is a completely different story. I think you will find that I'm pretty open and honest when we are wrong about why we get it wrong. I try to be as transparent as possible about what I'm thinking and what our numbers are. And when we miss, I try and be very transparent about why I think we missed and by how much we missed. If you want to talk a little bit more about our accuracy, I'm happy to do that. I'm always a little hesitant to talk about accuracy, just because there are several ways that conversation can go, and not a lot of them turn out to be positive for me, because who really believes anybody's accuracy numbers, right? And so if I tell you a number, there are essentially three choices to the end of that conversation. You can either walk away completely believing me, or you can walk away thinking that, yep, I believe his numbers, but I don't think that they have any special edge. And so there's going to be a period where their forecast accuracy returns to the mean, and with my luck, that's probably just as soon as I sign up. And then the third option is we just don't believe your numbers at all. 2 of 3 of those don't work well for me, so we don't really talk about accuracy too much, but I'm happy to share with you the numbers that we have that appeared in our study. About 3 months out, we had a mean average percent or mean absolute percentage error, a MAPE of about 5%. In markets that have futures markets associated with them, or commodities that have futures markets associated with them, we were about 1% on average better than the futures markets 3 months out. By 6 months out, we're about even at 8 to 10% MAPE. And by 12 months out, the futures market's better than us by 1% or 2%, and the MAPE is about 11 or 12%. Hopefully that helps. If you want to have a longer, deeper conversation about accuracy, please let me know. What impact do you see in RD values with producer credit due to lower value for imports? So one of the interesting things about the switch to the IRA credits from the blender's tax credit is there's going to be a significant reduction in the industry's revenue. So everybody that makes renewable diesel or biodiesel from soybean oil, assuming they continue to use soybean oil, will go from getting $1 a gallon from the blender's tax credit to essentially nothing. And that if you think of the RINs as a as a sorry as a if you think of RINs as an insurance policy on revenue, then a significant decrease in the revenue for the entire industry should have an impact on RIN prices. So the ultimate impact of the switch from the blender's tax credit to the Inflation Reduction Act credit should be an increase in RIN prices. That said, RIN price, much in the same way that that we think about soybean prices relative to the last 2 or 3 years, I think RIN prices are kind of in that same category where people are looking back and saying, well, RIN prices were $1.20 or whatever, not that long ago. But if you look back farther, RIN prices are about where they have traded historically. And so I think that there is a case to be made that RIN prices can stay right here. However, in the same way that, soybean oil prices ran up to 90 cents before there was ever any real change in the fundamental of soybean oil, and RIN prices ran higher. Now that the fundamentals of soybean oil are getting more bullish, prices continue to come down because of the speculative fervor from the demand shock has kind of worn off. And I think every part of the industry, any part of the biomass-based diesel industry that has a price that's attached to a market, is kind of undergoing the same process where prices blew out and now they're coming back. So while the insurance policy portion of the RIN value should respond to the loss in revenue, ultimately it may be that sort of if you look at the revenue, however you want to sort of slice it up on a per gallon basis or whatever, in 2025, and you compare that to 2017, it may be the same. And in that case, then the insurance policy, if you think about it in insurance policy terms, would say, well, we're not going to pay you because you haven't lost anything. And so it may be that that we make the switch and RIN prices still stay close to where they are because they were inflated before that. And so now they are in the payout is proper for the monthly premium, if that makes sense. The thing that that we don't know is whether that is how it actually works, because there is, and we've talked a lot about whether RIN prices are related to feedstock costs or are related to the actual supply of RINs. All of that, I think this year, I think there was a strong case to be made that RIN prices were responding to the overhang of RINs. Traditionally, that hasn't been the case, and they've been more highly correlated with feedstock costs. And if that's the case, if it's not an insurance policy on revenue, I think that's what it was meant to be. But if it's not an insurance policy on revenue and it's just related to feedstock costs, then we probably are not going to see RIN prices back where they were anytime soon, unless there's a serious shortfall in feedstock production. Sorry, this is a long question. So it's a long question. I'll summarize. The IEA had a renewables webinar, and there's sort of some insights that this person would like to get my opinion on. The insights are from the webinar: a 50% expansion in renewable diesel capacity in the US, a decline in biodiesel capacity in the US, substantial uncertainty around SAF with projections ranging from 2 billion to 8 billion liters. And so generally what I think is renewable diesel, I think that's relatively easy. I know I just answered this question the other day. Our expectation for the expansion in renewable diesel capacity is similar in 2024 to the expansion that was realized in 2023. So I think that makes a lot of sense, in particular because a lot of those plants that are expected to come online in 2024 will have been under construction. So the deterioration in margins, unless the development financing runs out, aren't likely to have a significant impact on the capacity that comes online in the future. So maybe the projects get delayed or something a little bit, but if they've started construction, I assume they're going to finish. And we assume it in 2024 now. As we get into the year, we'll probably adjust that around. But I think renewable diesel capacity expansion is probably as much of a layup as you get in being an analyst. A decline in that biodiesel, that one I think is much less certain. I think there are two ways that you can go with that. One, you can kind of say the increased competition from renewable diesel capacity is going to pressure biodiesel margins and eventually biodiesel capacity. We haven't seen that so far. Biodiesel capacity has hung on much longer than anybody expected, or maybe not anybody, than I expected, certainly. And there's, I think, a fair argument to be made that biodiesel could find some niche markets like heating oil in the Northeast and bunker fuel that could allow it to remain close to 2 billion gallons. And I've heard that argument made from some people that I think have a very good understanding of how this industry works. And so I don't discount that one at all, even though I think there are very, very few people that if you asked would honestly say that they expected biodiesel capacity to remain at 2 billion gallons. The uncertainty around SAF, I think SAF is coming. I think it's just a question of how quickly does SAF come. You've already had big ag companies like ADM commit to converting a substantial portion of their ethanol capacity into SAF production or to SAF production. A lot of the new renewable diesel plants and a lot of the renewable diesel facilities that were existing are adding SAF capacity or have plans to add SAF capacity. I think the part of what is causing the confusion is that there isn't a lot of solid information out there about SAF. It's hard to get a price for SAF. The volume of production is so low right now that it's hard to imagine we're actually going to produce 2 billion gallons of SAF anytime. But I think that like I said, I think that SAF is probably the one that sort of goes worldwide. And I think a lot of the developed countries that haven't implemented a biomass-based diesel policy yet probably will ultimately enact SAF policy. And so I don't necessarily think that it's a question of if, I think it's just a question of when. And President Biden laid out a goal of 3 billion gallons, I think, by 2030. We shaded that a little bit in our projections. We don't quite use 3 billion by 2030. We're a little below that, not hugely. I don't even know that we're much more than 1 billion gallons off of that. But I think that's more how it goes. So that's the quick and dirty. This person, I'm going to give you a call later today to talk about something. Current RD prices in California reflects a NYMEX price basis rather than a CARB diesel due to exports out by California refiners. Do you expect this to continue? That's interesting. I don't know that I would expect it to continue. However, I also know that in addition to the changes in the LCFS program, I think that CARB is also making some changes to, or if it's not CARB, it's the DOT in California, making some changes to semi regulations. And I think that if it is going to continue, those regulations, which seem to be relatively unpopular with truckers, in part because I think there's like I don't know if there's a fuel efficiency standard or there's something about the new regulations. I've seen a couple of little reports that suggest truckers really are not happy with them. And so to the extent that California is exporting fuel because the domestic demand isn't there because of the trucking thing, I think that that's probably what might be driving it. However, I do have to say that I have not really looked deeply into this, and one of the things that that has been a bit of a mystery over the past couple of years has been biodiesel trading at a premium to renewable diesel in the California market. And so I wonder if this has a little something to do with that as well. This is a good question. So please reach out to me and give me a little bit to do some digging on this and to talk to some people and see what they think, and then I'll have a better answer for you than what I have just given you. Apologize for that. Are RINs going to zero? No, that is a fantastic question. I don't think they're going to zero. I'm sure it feels like they're going to zero right now, but I don't think they are. If they didn't go to zero when the industry was much smaller and it was carrying over 3 billion RINs from year to year, 2 or 3 billion RINs from year to year, I don't think that it's going to zero now. However, like I said before, I think it could be, I think there's either they kind of stay here because this is sort of the equilibrium price, or the changes in credits over the next couple of years will get them back up there, back to where they were recently. Maybe not forever, but maybe for a little while. But I don't think that I don't know that there's a huge downside risk from here. That said, they probably will go to zero now that I've said that. All right. Thank you for all the wonderful questions this week. I really do appreciate the questions. Really, really do. And the more questions you ask, the shorter the presentations get, just FYI. All right. Thanks, everybody. Have a great week, and I'll see you next Tuesday.